They're giving you wrong information. When he told you to buy Merrill Lynch, remember? And what happened? They went broke.
Get the truth at philsgang.com.
Join my gang, philsgang.com. Get the truth. And also listen to me on my podcast on YouTube and Rumble. That's philsgang.com.
Phil Grande has successfully taught tens of thousands of investors how to navigate the market with confidence.
Hi, I'm Phil Grande, philsgang.com. That's right, philsgang.com. Join my gang for 10 days. It's free. If anything, during that 10-day period, you're going to learn how the market really works. You're going to find information that you never had before. You're going to walk away and go, I didn't know that. So join my gang for 10 days free, philsgang.com. And you're also going to learn how to make money when the market goes down. It's kind of silly just sitting there when the market going down, hoping. Why hope when you can sell short and make money? Either way, you make money when the market goes up, you make money when the market goes down. That's the benefit of Phil's Gang. You make money.
Become a Phil's Gang member and receive the training, advice, and software that will take your investing to the next level.
philsgang.com. Sign up free for 10 days. Whoa.
Now, here's Phil.
Good afternoon, and welcome to my podcast. You know, it's interesting how most people don't understand how the money system really works. And it's upsetting because it's not difficult to understand. They make it that way. They try to, but it's not difficult. But we get BS so much. I mean, especially Powell. I have a tough time with Powell. I don't know if he's just a dope or he's conniving. Like, for example, and which I'm going to talk a little bit about today, I believe he's trying to set up Trump for a market failure through increased inflation, so that when he leaves, which I think will be after the first of the year, he leaves, that we will have a whole bunch of inflation, and he's going to have to raise, the new guy's going to come in and raise the Fed rates to fight inflation. So I want to talk a little bit about that. But also, you know, we're looking at the market today, it's down 414 points. And by the way, when you look at the Dow, and everybody talks about the Dow, you're driving, the Dow's down today. They talk about the Dow, right? But they've got everybody's mind trained or focused to the Dow. When they see 400, there's only 30, you have 30 stocks, right? When they see 400, oh my God, the market's crashing. No, you got to go in and take a look. I always tell this to my gang members. Go in and take a look at the stocks that are causing that big move. If the 30 stocks, the 400 drop is spread around on most of those stocks, okay, then you got a problem. But when there's only one or two or three stocks, for example, today, one of the big moves is oil. Chevron is down, so that's one. Boeing, no, not Boeing, I'm sorry. The other one is, that was down. Let me just make sure I have them right here. I'll make sure I give you the right list. Where'd they go here? McDonald's, that's down, okay? JP Morgan is pulled back today. As I said, oil, CVX, Chevron has pulled back today. And there's another one that's pulled back. That's really about it. There's, let's see, Boeing, let's see, CVX, JP Morgan, and that's really the ones that are pulling the market back. So when you look at it, you got to put it in the right perspective. You got to go down your Dow 30 list and see which ones are causing the havoc. There's only a couple. Then you're going to overreact. You say, get me out, and you shouldn't. So don't. And most people do that. They overreact and they say, oh, the Dow's down 500, down 600. If it's only a couple stocks doing that, I've seen this market down 600. Only 2 stocks have taken it down. So don't do that. Okay, let's talk about what's going on here. What happened last Wednesday? Everybody was celebrating. This is great. We're going to cut the rates, man, and we're going to print money. We're going to print money again, and we're going to buy treasuries. We're going to do another QE. But that's not what he said. Everybody's interpreted it as a QE. But he is going to do a QE, but he's masking it. He doesn't want us to know he's doing a QE. Because remember what QE does. It does a terrible thing. The first thing, it screws everybody except the top 10%. Again, remember, 93% of people who are in the stock market lose money. So let's just say the top 10% grabs all the money, okay? And to do QE is a terrible thing, because just like in 2008, when they did QE, they said the same thing. We're gonna for 3 months, I think it was 65 billion. We're going to do 65 billion. We're going to have the Treasury print 65 billion every month, and I'm going to take that money and go buy the 10-year Treasuries. That means the more Treasuries I buy, then the yield on the 10-year Treasury will drop. That makes your car affordable, your house mortgage will be better, your credit card won't be as high, and everybody's going to get a break. This is going to be a wonderful thing. Well, no. First of all, where does the money come from to buy the Treasuries? They have to print it. So that's an inflationary problem, number one, right? They got to print this thing. QE is a terrible thing, because not only does it create inflation, QE with these stock buybacks do nothing for you, the worker, wherever you're working, does nothing for you. It does nothing for the company. QE has always been designed to take care of the very wealthy, the top 10%. Where 93% of all stock gains go. That's the key with QE. That's it. They take care of that. They can lie to you all day long. So all of a sudden now, we're told last week, okay, we're going to cut the rates, and we're going to start printing 40 billion a month, and we're going to start buying treasuries, and everything's going to be wonderful, and the market's going to go up like crazy like it did in 2008. The very next day, and by the way, I said none of it's going to happen. As a matter of fact, the day before we announced, on the 10th, on the 9th, I told everybody it's not going to work. The 10-year Treasury is not going to go the right way. I said, give it a chance. The 10-year Treasury is going to go up, just like it did the last time in September. Just give it a little chance, and you'll see it's going to go the wrong way. So anyways, and there's no benefit. But everybody was so excited about it. So here's what's going on today. So now he said, we now are in a rotation. Everyone's coming out of AI tech stocks. Everybody's getting rid of its leaders, okay? Everybody's selling the leaders. And you can't blame them to sell the leaders, because they're doing they're doing terrible, okay? Just terrible. And we're losing a lot of money on those stocks, right? So what's going on is the bank stocks, okay? Everybody's switching over to the bank stocks, switching over to discretionary stocks, industrial stocks. Everybody's moving out of tech into, let's say, the mainstream, okay? So banks, discretionary, airlines, casinos, whatever, McDonald's, and industrial, and like FedEx and Caterpillar, those sort of things. So everybody's now moving towards those. But one thing we know about Powell, when he says he's going to cut the rates, and he's going to print money to go buy $40 billion worth of treasury. Something's wrong, okay, when he said that. It didn't make any sense. Because, example, according to Powell, after reviewing the data, remember, this guy is data-driven. He's nuts with data. He's data-driven, right? And he came back and he said, we have a strong future ahead of us. We have easier credit. Of course, that's bank stocks. More households are going to spend like crazy. They're going to just start spending again. Now, remember, the households he's talking about, the application denials just on refis are up 46%. So he's telling us last week how we got a strong future in 2026, and we're going to have easy credit. Well, wait a minute, that's only about how many weeks away? 6 weeks away? Not even that. Okay, easy credit. Are you kidding? We still have denial, application denial. We have a crisis. I mean, imagine refis, rejections up 46%. So what is he talking about? He said that, we're going to have a strong future, going to have easy credit. Well, I mean, today is what? Today is December 16th, for God's sakes. What, 15 more days? All of a sudden, we're going to have easy credit. 15 more days, there's not going to be any more mortgage refi rejections of 46%. No more auto financing rejections, up 15%. And just plain mortgage application rejections up 20%. Oh, those go all the way. We turn the page, January 1, when the ball comes down, we change that all goes away. Bunch of BS. It's not going to happen. So where's the strong future? 5 minutes. Now, what he's saying is, we're going to have more household spending. Is this guy nuts? Household spending, bankruptcies are going up. Delinquencies on cars and mortgage, all going up. What's he talking about? And he's saying that we're going to have industrial stocks now. You got to buy industrial stocks, he's telling us, and material stocks, because productivity is going to scream. Productivity is going to be strong. So we got productivity is going to be strong, discretionary stocks, casinos, hotels, McDonald's, all these stocks. People are going to go back out to dinner. And by the way, food at restaurants are up 26%, the inflation. That's why restaurants are closing left and right. All these stocks, especially these change. And then he says we have this, so we got this strong future, banks, discretionary, industrial. That's where you want to be. You want to be in those stocks. Okay. He claims his data is right on. It's telling us we're going to have a strong economic growth for 2026. This is what he's saying. And he said, even if the labor market's weak, we are going to have a strong economic growth. Then he says, his data points are telling him we definitely are in a soft landing. And the economy is resilient. Where do they get that word resilient? All we hear is resilient. The consumer's resilient. Everybody's resilient. What the hell is that? Anyway, so a resilient economy, and he says our growth is going to increase in 2026 to 2.3% from 1.8. Is this guy nuts? This is crazy. Our debt to our GDP growth is what? 170%. We should be at 60%. That means we can't get credit. How are we going to grow without credit? And also, our biggest lenders, China and Japan and the UK, they're not lending to us. They're not going to lend us at 10 years, 20 years, 30 years. They're not doing it. They're buying gold instead. Was this guy nuts? Now, my question to him is, wait a minute, if you're telling me all of this, and we're going to have a great future, then why do you have to cut rates? If we've got such a great future, have such great growth, 1.8% to 2.3%, everybody's going to do wonderful starting January 1. There's going to be in the streets dancing. Then why do you have to cut rates? You don't cut rates. Because if you cut rates, you're going to cause inflation. You're just going to raise. What are you talking about? Are you just a dope? No, here's what he's doing. He doesn't want to tell the truth what he's doing. He's screwing you, he's screwing me, he's screwing everybody on Main Street to screw Trump. This is what I firmly believe. Because what he is doing right now, on his way out, he is purposely increasing inflation through printing money to purchase. And here's the other thing. Everybody's thinking this is QE. And he's going to be purchasing 10 Treasury bills, 10-year Treasury bills, right? No, he's not doing that. He's not telling people that. You know what he's buying? He's buying short-term T-bills. Is he nuts? He's not buying it. Remember, in 2008, they're buying 85 billion, 125 billion a month of 10-year treasuries to bring that yield down, so you could. Because remember, what's tied to a 10-year treasury yield? Your mortgage rate, your car rate, your student loan rate, your business loan rate. Everything's tied to that. So that's not what he's doing. What he's going to do is this guy is going to purchase T-bills. T-bills. That's a terrible thing to do. Now, at some points, a T-bill can work for certain situations. But when you're going out and you're buying T-bills, what he's basically doing, he's masking another QE, and nobody's going to catch on, he's thinking, if I do T-bills, if I do short-term, if I buy treasuries at 1 month and 2 months and 3 months, which is crazy. Nobody's going to know. So this is not going to work. So the new Trump Fed chair, he's going to have to raise these short-term rates when he gets in to fight the inflation this guy is creating. This is nuts. I mean, I don't know. Maybe I'm wrong, okay? Maybe he sees something I don't see. But here's another thing. Remember the T-bills, how important they are. You know your money market funds? Those are so important because everything is a money market fund. What do I mean? If you go, let's say you're going to buy stocks and you open up a brokerage account and you put in $50,000. Where does that money go? Does anybody know where that money goes? The brokerage company will go out and it'll buy money market funds. So any brokerage account you open, there's cash sitting there. They don't leave it in your account. They want the cash to work, so they go and use money. They purchase money market funds. And so does it, again, brokerage accounts, 401ks, that's what they do. We'll talk more about that when we get back. And what is he up to? And what should you buy for stocks?
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
When you listen to the advice of Phil Grande at philsgang.com, you'll find investing in the stock market makes sense with the right guidance.
People keep saying to me, boy, things are hard, things are tough. Boy, the market's really screwed up. And I don't agree with them. For us here at Phil's Gang, we make it so it's simple. It doesn't matter if the market's bad or good. We consistently do well because we make it simple. And just like for my listeners on the radio or on the internet or my podcast, we make it simple. We try to break it down so you really understand why the market is going up or why there's continued inflation or why the bank rates are going up. So you understand, especially yields. The most important thing to understand how yields work. Just what we do. We work hard at it.
Trusted advice, easy to understand strategies that will make you a better investor. Get all the details at philsgang.com. That's philsgang.com. Welcome back. Learn, invest, and make profits with Phil Grande. Simply go to philsgang.com. Now, here's Phil.
And welcome back. Okay, so let's talk about why is he buying T-bills. Well, first of all, why is it bad to buy T-bills? Because, one, it pushes down the short-term interest rates. That's what he's trying to do right now, okay? So I get a little confused with him, okay? Because what he's doing is trying to push down short-term interest rates. Now that hurts the savers. That's hurting you, the saver. That's hurting your money market funds, which we rely on so heavily for everything. I mean, like I said before the break, if you're going to go and open up a brokerage account, when you put a check in for 50 grand, what do they do with the 50? They go and they start buying money market funds. That's what they do. And then, for example, you open up a 401k, you put money in there. They take the money. What do they do with it? They go and they buy go right to the money market funds. I mean, 401ks, pensions. I mean, you can go on and on and on. This is what you need. So it's very important. So what he's doing is he's going to hurt the savers. He's going to hurt the money market funds. This is nuts. This is nuts. So I don't know what his point is. He's just, other than, I'm going to control the short-term rate. I'm going to make sure the short-term rate doesn't go up. It's too late. We already have the inflation. You're going to have to raise your Fed rate, which is short-term, to fight the inflation that you're creating by doing QE, which you have to print money, you idiot, to go and buy long-term treasuries. What the hell? I mean, what is this guy? This guy's nuts. So again, the other problem we have is the repo market. It hurts the repo market. Repurchase agreements. So banks are in trouble right now. There's no money. So they have to go at night and Powell get together with them. They'll put a pool together and they'll purchase from the banks their assets, like their T-bills or whatever they have, or mortgage-backed securities, so they got cash to operate again, to go lend with the promise they'll buy that back. If I go in and buy from the banks $1 million worth of mortgage-backed security, they're going to promise me they're going to come back and buy those back from me at a profit. So again, it hurts the repo market. It also, remember, when you have a big demand for all these T-bills, I mean, nothing works. It just doesn't work. T-bills are a great thing. It's a great vehicle, the T-bills, okay, to fund, as I said, short term. You put your money in these T-bills, and the main thing, the idea is, it's going to help the money market funds that we need so badly, okay? Because no matter what we do, if we give money to any financial entity, they take the money and they want to make interest on it for you. They put it into the money market fund. In fact, the money market fund is so important because he's facing, I think this year here, he's got to pay what, $6 or $7 trillion. Part of our debt is coming due. And when I hear everybody go, oh boy, we're going to default. No, you're not. We got plenty of money in the money market fund. So we can cover that out of the money market fund. That's no problem. But that's what that does. It's so important. So I don't know what the hell he's doing with that. But it just doesn't make sense. Now, again, is that, remember, we still have this big problem. I get so upset when I hear people say, what are you talking about? We don't have $600 billion in bank losses. That's all fake. You'd be right if it wasn't on the balance sheet. But go look at the balance sheet. They're on there. You know, accounting firms don't put them on the bank's accounting, a bank statement if they're fake or phony. They're on there, but they just have a category where those losses, you don't have to realize those losses as long as we keep the our reserves up to, I think it's now $4 trillion if I'm right. Okay, they used to have $45 billion in reserves. Now I think you got to keep it at I think it's 3 trillion, 3 trillion, that's right. So the U.S. banks are now, I'm reading it right here, I just found it. The U.S. banks now require over 3 trillion in reserves. We dropped from 4 trillion to 2.5 trillion. So what can happen here now is that those unrealized losses that have been sitting for 600 billion, been sitting there, and they didn't have to realize them. Well, guess what? As they drain down reserves, and T-bills will do that, that means that they're going to have to sell once to raise money to push up that 2.5 billion, okay, or trillion, to push that back up to where it's supposed to 3. According to what I just looked here, it's got to be at 3 trillion. So banks require 3 trillion. We're below that at 2.5 trillion. We dropped from 4 trillion to 2.5 trillion. So, and what's happening, why we keep dropping it, because these T-bills are getting so popular, okay? Because they're short term with rates of 3.6%. You can get a month, 2 months. People love them, and Trump's buying the hell out of them too, right? So again, the problem is everybody's buying these T-bills, and I mean, we're funding the debt with the T-bills. People are buying the T-bills to get short-term interest rates. That affects our reserves, and that could be a problem. Going back to what's going on with last week and where we are today, what stocks you should be in, again, you got to learn how to sell short. I know you hear me say that all the time. Okay, and right now, talking about what's going on with this repo market and all that, the banking system is weak right now, okay? And the repo market is very weak right now. Yes, the T-bills will inject liquidity directly into the short-term funding system that the 10-year Treasury doesn't. Yes, that's good, but it's like a Band-Aid. Again, we have an unstabilized repo market, money markets, short-term funding, bank reserve. They're all unstable, but nobody wants to talk about it. So as far as stocks right now, everybody's telling you, and it makes sense. I mean, you take, I mean, just think about the tech stocks. The tech stocks have gotten really crazy, all right? I mean, they're upside down. The valuations are very, very, I mean, just insane. And the valuations are so stretched. The prices are too high. Valuations are stretched. I mean, one day these things are going to really, really tank. So you got to be, again, but people will keep running back into these tech stocks. And I don't know, I think the reason why Powell thinks that the reason why he wants to get out of the tech and go into banks and go into industrial stocks and so forth, he may think the timing's perfect, for AI, because again, AI tech, after all this hype, is a bunch of nonsense. This hype, there's no returns. The hype is bigger than returns. The rate cuts, okay, are helping banks, okay, and he said that rate cuts are going to help discretionary, but it's not going to help tech, so the rate cuts will not help your tech stocks. At times they do, but not now. And you take the AI leaders, NVIDIA, AVGO, Oracle, Amazon, Google, prices are tanking and valuations are so stretched. I mean, just unbelievably stretched. Anybody that's in these are nuts. Now again, if you go look and you see the bank stocks are up, our gold stocks are up, a lot of our stocks are up that are outside of these, but you're going to have people running back to these because people are addicted. So we have the valuations are stretched, the prices are tanking, and your leaders are dead, okay? But they're jumping into they're jumping into banks, and they're jumping into discretionary, and those aren't safe. Those aren't safe. For now, sure, they're going up. Here, look, Sure. If you go by, let's go take a look at some of the stocks here. If we go by today, Johnson and Johnson, okay, it's one of our stocks. Okay, it came down a little bit today, but it's been going up beautiful. We had a nice trade over a flag pattern, beautiful. Tesla, that broke out today. We're doing good with Tesla. That's a nice breakout. Our JP Morgan, we're hoping that breaks out soon, hasn't yet. Our Morgan Stanley, okay, we're waiting for that to break out. Our Delta Airlines have broke out. So again,
5 minutes.
so this transition from NVIDIA and Oracle and Google and Amazon, and you go and you start buying bank stocks, or you start buying, the only thing we're heavy in gold mining and in silver. We're very heavy in there, okay? Those are our big money makers, okay? Our healthcare was a big money maker, but they started to get hurt. But right now, we're making good money in Southwest Airlines. We've been in that for a long time. We've been in Lilly for a long time, and right now I wouldn't buy Lilly right now. We took most all our profits because the trend is going down again. So again, with this idea that he's saying, I'm going to cut the Fed rate. I'm going to buy $80 billion a month in treasuries. He doesn't tell people it's the T-bills. He's letting people believe it is the 10-year treasury. He's misleading people, okay, to make it look like it's not a QE, okay? So he said, well, that's not a QE because I'm buying short term. I'm buying T-bills, so it's not a QE. But it does the same thing. When you do QE, you want to put pressure on the 10-year treasury yield to go down. When you buy a massive amount of short-term T-bills, you're putting pressure on the 10-year treasury yield. It helps push it down, okay? So all these stocks right now that you've been in and you're losing a ton of money in, just think if you knew how to sell short. This is the only protection you have in this business. I mean, think of the money you've been losing on the Magnificent Seven, but we've been making, and you've been losing. ARC is a great example, okay? Another one, look at the Qs. They got clobbered. If you only knew how to sell them short. But everybody's been living and dying by these tech stocks. That's all they've been buying is tech. And the FOMOs keep buying. Every time they go up and they peak, they go buy them. Now the bank stocks that are starting to rotate, in other words, they're getting out of tech, going to the banks. Those aren't going to last long. Don't feel, okay, I'm in banks. We're in the bank stocks. We're doing well with Citi. We're doing well with our Goldman Citi, Goldman Sachs, another one we're in. We're doing great with all of those. We're doing great with our gold and our silver. They're all up big. But if you take any discretionary stock, like Southwest Airlines, which we own, Delta we own, Walmart we own, all going up, they're not going to last. They're not going to last. So we stay in them as long as we can. They're not going to last because we have too much debt and deficits. And when you have too much debt and deficits and you have too much corporate debt, they can't anymore borrow money free. It's all going to start tumbling in on itself. There's nowhere to go. What are you going to do, buy Coca-Cola? Oh, yeah, I'm going to buy Coke. It's defensive. Please, you make more money shorting than you'd ever make going long. Because, see, when you go long, it takes a long time for the stock to move up. Because it moves up a little bit, comes back a little. Moves up a little bit, comes back a little. Shorting, if a stock's at 50, it'll go right down to 5 like in a heartbeat. Okay, because there's no buyers. They're shorting it. Everybody panics. That is your safety net. We can show you how to sell short. It is not hard. Not hard. I'll leave you with this. Every Friday night, invite people to your house for dinner. Then tell them to put on a napkin what stock they're in. Then take the napkins, put them together, take the stocks, and do the opposite. Short them. You will make a fortune. You will make a fortune. I'm begging you. Let us help you learn how to sell short. There's no place to go anymore. There really isn't. See you on the charts.
been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.